Hey everyone, making a new video today after I believe it's been about a week or so. Tried to get this video out earlier, wanted to get it out a few days ago, wasn't able to get the chance to get it done, but I finally got the time to make that happen. So I'm going to be making a video today talking about developments from the last video I made. If you haven't seen the last video yet, I would highly recommend you watch it first. It's going to be the last video on my YouTube channel. So you get a background of what we're talking about here. I'm just going to continue on from where we left off last week. I'm not going to go over any of the alternate cases. I'm going to go over the one that I had as the bearish case, the one that I was leaning towards, and the one that seems to be playing out at this time. We're going to talk about what we were expecting last week, things that went a little bit different from what we were expecting last week, and where we are now and what we should be looking for. I'm also going to talk about a couple of the bullish scenarios that a lot of the guys on Twitter have been posting. I've been seeing a couple of different bullish scenarios from a couple of different guys on Twitter that I keep seeing again and again and again, and I'm going to go over why I don't believe that those are going to play out, the problems that I have with those particular counts, and why I now believe that 8.5K, the level that we hit before this last big dip that we saw, was the short-term top, and I don't believe we'll see above that level again until we see new lows, so until we see sub 5.8K. So I'm going to talk about the LE wave counts, and I'm also going to talk about another macro trend that I noticed that's prevalent in other markets as well, and that we're now seeing here in Bitcoin. So we're going to go over both of those, and we're going to start off with this chart here, which is the same exact chart that I had in my previous video. So if you go and check out my previous video, it's the first chart that I talked about, and this is going to be the larger picture, the overall correction starting from $20,000. Which is the bearish case, which I said I've been leaning towards for a while now. So going from where we left off last time we were up here making this three-wave structure, had reached about 7.5 thousand, and I said I was expecting that three-wave structure to be the end of an X wave or a B wave in this ABC of this Y wave, and then I was expecting us to come down. I had some short order set. I believe I said around $7.8 thousand, expecting that to be the top. I did state that everyone was expecting that to be the top, so I expected to see either two things: one, us not actually hitting 7.8 and then coming down, or two, us blowing through 7.8 and then coming down after. And we ended up doing just that. We blew through 7.8 thousand, spiked up to 8.4, 8.5 thousand, and then we had our big dip starting. So in the shorter term, if we look at this particular structure, I want to go over the structure right here. So here's that particular structure zoomed in. There was some confusion, and last time I talked about this as well. We had what I was expecting to be a three-wave structure, and this is how I had it drawn out last time. Just like this here, we had the A wave, we had the B wave, and then we had gotten up to here, and I thought that this was a 1, 2, 3, 4. Thought we'd get our fifth to right about here, and that would complete the third wave. However, I remember I talked about the way that this looked really odd with the tiny first wave, this being a third, a fourth, and then I said if we do get a fifth wave, it's bound to be very small. We're allowed to get a large extended third, but that would mean that the first and the fifth should be similar in size, or that the fifth should not extend more than 1.618 of the first. I know I'm talking a little bit fast here, guys. I'm just trying to get through this video a little bit quickly. But basically what I was trying to say is that with a tiny first and a long third, our fifth would end up being not so long as well, which gave us right around 7.8 thousand. That was also a confluent resistance zone with all the other resistances I talked about, the 200 EMA, the horizontal resistance levels, all that good stuff. So my thought was that we would end our fifth wave here. And then what ended up happening was we blew actually way past that, and we shot up again. And this is where things got a little tricky. A lot of people got very bullish with that move up there. But as I've been saying on my Twitter for a while now, and what I wanted to explain today was the bullish counts that I've been seeing here. So a lot of people saw that push up as a continuation of this wave, and then they believe that this was a new impulsive wave up, a new five-wave structure, as opposed to the three-wave structure that I initially talked about. And I said, okay, if that's the case, I'll go ahead and entertain that. But if that's the case, then I saw this particular wave up. Now remember, if this is a five-wave structure, we have a 5, 3, 5, 3, 5 structure, right? As far as the subwaves go, which means that this structure has to have five waves on its own if this is going to be a regular 1, 2, 3, 4, 5 impulse. And what I had seen was a clear a clear three-wave structure. You can see this 1, 2, and 3, and we had not made a fourth wave, and we had not made a fifth wave. We'd only made 3 waves. Now, the way that some others were labeling this, we're going to focus in on this giant wave here, right? This supposedly third wave. Third wave, let me draw this a little bit more clearer. What now seemed to be supposedly a third wave in a 5-wave structure. So let me get rid of this guy real quick. And we'll zoom out a little bit. Let's go to the 2-hourly chart. So yeah, because of the strength of this move up, instead of capping here, we pushed up a lot higher. A lot of people thought, hey, this is a 5-wave structure, and it's the start of a new impulsive wave. And so I said, okay, if that's the case, we want to see 5 subwaves here, and then we want to see a 4th wave retrace, and then we want to get our 5th wave up here. And what happened was we hit this top over here, and we started moving down. And so what I would think before this price action developed, I would think, okay, this must be our 4th wave here, right? So this must be our 4th wave. Sorry, let me fix that here. 5-wave structure, we got 1, 2, 3, 4, 5, right? So I was expecting this 3rd wave to extend out to here maybe. We'd get our 4th wave dip right here, our 3rd wave, and then we get a larger 4th wave, and then we'd get our 5th wave, right? So let me just change this color here to make it a little bit more clear. So this would be the subwave count of this 3rd wave. We would have gotten a 4th wave and then a 5th wave, right? So my criteria for invalidation on this particular scenario was a dip below 7.5 thousand. And the reason that I had that as the invalidation criteria was because, as we know in a 5-wave structure, the 4th wave, this particular dip right here, cannot dip below the start of the end of the 1st wave, in this case around 7.5 thousand. So what I said was that if this really is a 3rd wave and this really is a 5-wave structure, this 1st wave up, a very impulsive, strong move with barely any retracements, I said that this was an extended first. We had a 23% retracement being the 2nd wave. Now wave 2s are typically, sorry, one second, my dog, let me get my dog inside. All right, so back to the video. What I had said was that with an extended wave, we tend to see shallow retracements. In this case, we got a 23% retracement. Now, wave 2s are normally going to be deeper retracements, but after an extended wave, the retracement is generally shallow. So we got a 23% retracement here. That's fine. Then we got this next push up, and then we got a dip down. So if this next push up was our 3rd, this dip down would have to be our 4th. The retracement was deep. We got a shallow retracement here. We got a deep retracement here. And then I expected us to continue up in the bullish case for a 5th wave moving upwards like that. And then what happened was we moved up and then we dropped. We did not get that 5th wave. And as soon as we went below the 7.5 thousand level, I had to invalidate this count, right? So if this count is no longer valid, there's the invalidation of 7.5 is what told me that this count is no longer valid and that this impulsive move up is no longer valid. However, there's a couple of other charts that are being posted on Twitter that have us like this. So they have the 1st, the 2nd, they have this is the 3rd, this is the 4th, and they have this is the 5th, completing the impulsive 5-wave move. They have this particular move down as a corrective ABC structure as such, allowing us to then bounce from here and make another 5 waves even higher than this top of 8.5K. So the particular issue I have with this count here is just the symmetry of the entire thing. So normally in Elliott wave we talk about the right look, and this just doesn't have that right look. We got a deep wave 2 and a shallow wave 4, which is fine. But if we look at the structure of this thing and we look at the channeling here, we have our 1st wave, our 2nd, and then our 2nd, 3rd, 4th, and 5th wave all fit in a nice channel. But this 1st wave is way out of that channel, and that's not what we tend to see in Elliott wave. And what I commented when I saw some of these posts was that this particular move here channels very nicely, and rather than this being a 2, rather than this being a 3, a 4, and a 5, it looks a lot more like one wave in its entirety, just one complete wave. Just as this wave 1 was one wave, this particular move seems like a 2nd wave. It doesn't seem like it's a wave, a corrective wave of the same degree and then a third wave up. It just didn't make sense. Furthermore, the length of each of these waves, as we can see, is almost identical. We had our first wave, which was up to here. Our third wave actually went to 161% of our first wave, which is fine. It's what we'd expect. But in cases like that, we would expect our fifth wave to extend, and our fifth wave didn't extend. It cut off, and it became shorter than our third wave, and we ended up getting three waves that are all pretty similar in size. And normally in any sort of impulsive move, we'd see at least one extended wave. So now we have the issue with the symmetry, with the way that this whole section looks, and then we have the issue of us not getting an extended wave. And so those are the two major signs that make me believe that this isn't correct. I don't think that this is an ABC and that we'll be heading up. I think that 8.5 was the top. Now another scenario that I've been seeing as well is something like this here. So we have our 1, 2, we have our third here, we have this as a fourth wave, and then we have a fifth wave that should be going a lot higher. Let's zoom out a little bit more here. We have our fifth wave that should be taking us even higher. Then we'll get an ABC corrective move. Then we'll get another 5 wave that will take us to like about 10,000 or maybe a little bit higher than that. And so again, the problem with this particular count that I'm seeing, now technically you could argue it's still valid. We haven't dipped below 6.8 thousand, which is the end of wave 1. Our fourth wave hasn't gone below that yet. So technically, in that sense, you could say it looks valid, or it's still feasible. However, if we look at this third wave, and this is the problem that I had with this count, the biggest problem I had with this count. If we look at this third wave here, let's count the subwaves. The way that they've counted the subwaves is like this. Tiny little wave 1 here, a giant wave 3 here, a small wave 4, and then another giant wave 5. And let me change the color on that as well so you can see what I'm talking about. So this is the way that the people that have this count are counting it. And I've said this so many times, and I'll say it again, double extended waves, especially to this extent, where both the third and the fifth are over 500% of the first wave, double extended waves are not seen very often. And to see them at this extent, where you have a first wave that's a fifth the size of the third and the fifth waves, it just doesn't make any sense to me. I mean, if we're going to call these waves, this first wave, a wave of the same degree as this third and this fifth wave, then literally we can turn any three-wave structure into a five-wave structure anytime we want. All we got to do is take the first little retracement, make that a 1, and then we turn a 3-wave into a 5-wave. So I don't think that's valid at all. I would never call this structure, this clearly 3-wave structure, as a 5-wave structure. Yet some are calling it that, and then that's fine. I can always be wrong. I'm not saying I'm 100% right. Not at all. I'm just saying that from an Elliott perspective, this particular count makes absolutely no sense to me, just because of the wavelengths of this first compared to the third and the fifth. Now, that being said, if this wave structure is not a 5-wave structure, if it's a clear 3 waves, and we have this as an ABC, that doesn't work out either. So earlier I said we were looking at a 3-wave structure, an ABC, and the way that it is now doesn't make sense, because a C wave would also have 5 waves, and like I said, we're clearly seeing 3 here. So the only explanation for this particular move up, we've eliminated the possibility of it being a bullish count. We've eliminated the possibility of this being a third wave up. After breaking 7.5, I threw that idea out. So if this isn't a third wave up, if it's not a C wave up, if it's not a 5-wave structure, then it has to be a 3-wave structure. And if it's a 3-wave structure, this move cannot be a corrective ABC. But what it can be, and what I believe it is a corrective double combo, a corrective WXY, with this Y wave being an ABC on its own. So this would make a lot more sense than anything else that has been proposed. This is what I believe we are seeing, a double combo correction. Corrective waves can be simple or complex. In this case, we're getting a complex corrective wave, or a complex X wave, in the form of a double combo with an A wave, 5-wave structure, B wave, and then another C wave, which is another 5-wave structure, giving us a larger 3-wave structure, and keeping everything in play as far as this being the top goes. So now that we can establish this is a 3-wave structure, and we've established why that makes sense and why the bullish counts don't make sense, let's go back to the larger picture, which is this count right here. And this is going to be the bigger picture. And now that we've established this being a WXY, let's add it on there. WXY, like that. And that completes that corrective move. And then now we're headed down again for what I believe to be new lows. And this scenario stands. Now, a couple of possibilities here. We could complete this C, complete this Y, and that could be the end of the correction. More likely than not, though, I see us making another X wave up and then getting another Z wave down to give us a WXYZ wave triple combo correction to complete this correction. Now, if this decides to drag on for many, many more months, if this bear market continues for many, many more months, there's ways that we can define this in terms of Elliott wave, with this entire WXY structure being a much larger move down as opposed to a complete double or triple combo. But we'll get to that down the road. For now, this is what I see as most likely. This is what I had in my previous video about a week ago, and it very, very much seems to be playing out at this point in time. Now, I said I was going to talk about some other topics as well, aside from an Elliott wave perspective. I was going to talk about some macro trends that I noticed. So I'm going to go ahead and show you guys that chart. I posted it on my Twitter a couple of days ago, and I'm going to go into that chart now and talk a little bit more about it, since I seem to be getting a lot of questions about it. All right, guys, so here's the chart that I posted on my Twitter a few days ago, and I can't seem to find it on TradingView. I always end up deleting those things for some reason, but I'm going to go ahead and talk about the chart here and explain a little bit more in detail about what it means, because there is some confusion about it. But basically, we've seen that in other markets, and other traditional markets, if you take the S&P 500, if you look at it during major bull and bear runs over the past 10 or 20 years, so you take the bear run, the bear market in 2008, you take the bull run prior to that, and you look at the RSI levels over a longer period of time, over a longer time frame, we tend to see that rather than 30 and 70 being support and resistance levels, or oversold and overbought regions, we tend to see the 40 and 60 levels being of more significance. And let me open this chart somewhere else so that we don't have this thing popping up every 2 seconds. Give me 1 second. Okay, so here you go. So we tend to see that 60 RSI acts as resistance in a bear market, and in a bull market, 40 RSI acts as support. So in bull markets, if we take a look at this chart here, in the Bitcoin bull market, we never dip below 40 RSI on the 3-day chart. And if we look at the other time frames, the longer time frames, because this amount of time was so long, we'll see the same thing there, and we'll go over that in a second. But the point here is that the 40 RSI level acted as support during the Bitcoin bull run. We oscillated between 40 RSI and up here all the way up to 90 plus RSI during this bull run, and we never dipped below that level. However, when the bear market started, we broke 40 RSI for the first time since the bull run, and this goes back a couple of years. I know it's only showing 2017, but it does go back, I believe, to 2015. And so we broke 40 RSI support for the first time in the bear run, and after that point onwards, we have been unable to break above 60 RSI. So during bull markets, 40 RSI acts as support. During bear markets, 60 RSI acts as resistance, and we tend to oscillate between 60 and 0, just as we oscillate here between 40 and 100. So in this particular bear market, as you can see, failing to break 60 indicates that we are not yet ready to break out of this bear cycle, and we will continue staying in this bear market for a period of time longer. So that, as we talked about as far as Elliott wave goes, we saw 8.5 thousand being the top, and that just so happens that also was the 60 RSI level as well in this 3-day chart, and we rejected perfectly right off of it, which makes complete sense for this being an actual top. So that further reinforces my idea that 8.5 thousand was the top right here, and I do believe that we'll see lower lows before we see above 8.5 thousand. This RSI thing that we talked about, that also plays in with that theory. So everything's lining up here. Now let's go ahead and take a look. I've had people, arguing and saying, oh, well, we're on the 30-day chart. we haven't hit those levels, or let's just go over that and talk about that as well. So on the weekly chart as well, we can see here, let's go ahead and draw the support lines. So we're looking at 40, we're looking at 40 here, and we're looking at, let's see here, 40 here, and 60. So we'll go ahead and draw those lines. So 60. So if we zoom in here a little bit, we can see that again, when the bear market started, we broke below 60. We haven't yet broken below 40, so it's still holding a support on the weekly here. But what I was trying to explain to people that are arguing that this invalidates the point, doesn't invalidate anything. All it means is that we haven't been in this bear market long enough for the weekly RSI to make its way down below 40 yet. The idea is simply that if the 3-day is ranging in between 60 and 0, and it's oscillating in this range, it's the law of averages. It's just going to be a matter of time before the weekly also starts oscillating within this range. At the same time, if the 3-day at some point breaks up above 60 and heads up again, then the weekly may not make it down to this range. However, if we continue to oscillate here as we have been since, prior to April, it's just a matter of time before this weekly chart follows and breaks below this 40 as well. So on the weekly, as we can see, during this bull market, we maintained a level above 60 for the most part. We had a couple of dips below, but we maintained this 40 support. And in the bear market, as soon as it started, we have been unable to cross above 60. Just as we have been unable to cross above 60 on the 3-day chart, in the same way, we have been unable to cross above 60 on the weekly chart. And if we take the monthly chart has also just dropped below 60, and we have been unable, again, since the same period that's on the 3-day, the weekly, and the monthly, we've been unable to recover this 60 RSI level. We've stayed below it. And so, like I said, bull markets were allowed to oscillate as low as 40 and stay above it. Bear markets, once we dip below 60, we can't get back above it. So it's a matter of time before the weekly chart follows suit with the 3-day chart that we're seeing here. And it's just a matter of time before the monthly does as well. Now, for the monthly to get into this range as well, it's going to take a long time. And it would be unfortunate to see us get there, because at that point, this bear market would have lasted a lot longer than I or many others would have preferred. But it's something to consider. And so there's a chance the monthly never gets down to that range. It's right below 60, and there's a chance that it never gets to 40 or below 40. But it's just something that will happen with a matter of time if the bear market ends up being that long. But for now, this 3-day chart is a very accurate representation of the idea that 60 acts as resistance in bear markets, and that 40 acts as support in bull markets. And we will see this exact same range develop on the weekly chart as well, given enough time in this bear market, right? So this is what I was trying to say. Aside from Elliott wave, this is the other macro trend that we're seeing that reinforces the idea that we're not ready to exit out of this bear market yet. The rejection at 60, along with the Elliott wave top at about 8.5, reinforces the idea that we are headed lower at this point, and we're not going to break up higher. And for this reason, I'm looking to short. I'm looking to add shorts here in the immediate coming days. So this was a big drop that we had here. I'm currently looking for retracement for me to layer on some shorts. On my Twitter, I've been talking about downside targets since this drop began, and I said we'd be looking at 6.8 to 7.2 thousand as downside targets. And initially, I said I would not consider longing at 7.2 because of this gap here, and if we lost 7.2, we drop down to 6.8. And I said I would consider longing at 6.8 thousand, and I've since then retracted that. I decided to pull my orders at 6.8 thousand. I decided it's not worth the risk. Based on what I just showed you guys, this is just the beginning as far as the drop goes. And so I'm not going to risk longing at 6.8 when the downside is potentially huge and the upside is very limited. As far as the upside goes, I'm going to show you guys one more chart, but basically what I'm looking to do at this point is I'm looking for retracements to short. I'm looking for retracements to add on shorts. I'm not really bothering with longs here. I want to play with the trend, not against it. And based on everything that I've showed you guys, I believe that trend is directly down at this point. So I'll be looking at any sort of retracements as opportunities to short this market, and I won't be too concerned with making longs here. On that note, I'm going to show you guys one more chart that I posted on my Twitter that'll give you some insight as to what I'm expecting for targets on this retracement and where I'll be taking my shorts. So this is another chart I posted recently, and it's regards to the retracement levels that we can expect to see with this drop. And this is important because we need to know where to open our shorts to get the best reward, and also make sure that we get our shorts in there before this thing continues to tumble a lot lower. So if we take a look at the last major dump and we take a look at the major retracement periods, we see that almost every one did not exceed 38%. There was a couple, I think there was one that was slightly more than 30% that neared about 50%. But for the most part, all these retracements were about 38% retracements and not much more. And that's to be expected in strong downtrends. In strong downtrends, you have supports being broken. You have people that are longing, for example, people that longed at 7.2K that are now underwater, and you have shorts that are just waiting to pile on, just as we're waiting to pile on here. So we wouldn't expect to see particularly deep retracements. Anything more than 50% is super lucky, as for what I think. So I'm looking to take conservative shorts here, or to take conservative retracements here, so that I make sure that I get my shorts in before we get the next leg down. So based on what we're about 6.8 thousand right now currently. Actually, let me take a look here. Bitcoin is currently at where are we at? 6.9 thousand, right around 7,000. So from that perspective, if we take the prior patterns into consideration, and Elliott wave as well talks about shallow retracements after extended waves, I'm looking for a retracement here, depending on where we hold. So let's say we hold at the 6.8 thousand level. That was the initial target for the second target for the drop. If we hold here, I'm looking for a retracement to about 7.2 thousand as a bare minimum. 7.2 thousand is where I'd like to open shorts if we hold right here. And I will add shorts on at around 7.4 thousand. If you notice, those targets line up very well with horizontal support and resistance levels. This was our previous support that we lost, and it resides at around 7.2 thousand. That makes sense with our target right here. And the next level up being 7.4 thousand falls along with this chunk of resistance, this resistance zone here. We see all these wicks going up. This is a heavy resistance here at 74.70. So these targets make a lot of sense in terms of retracement targets. And we know that we don't go much more than 38%. So expecting us to go up to 7.7 to 7.8 thousand like I wanted to initially, I don't think it's going to happen. So I'm looking to open up shorts around 7.2 to 7.4 thousand based on not just retracement levels, but these horizontal resistance levels as well. So those will be my ideal short opportunities if we hold the 6.8 thousand and we get our bounce from here. Now, there's a situation in which we don't hold 6.8 thousand. If we don't hold 6.8 thousand, the next target based on fib levels, Elliott wave, everything is about 6.5 thousand. All right. So we know that a lot of people are expecting 6.8 thousand to hold, and a lot of them are going long here. So we always talk about this. There's a chance that we run these stops. They're going to be placing stops below 6.8 thousand because they're expecting 6.8 to hold based on all this prior horizontal resistance here. So assuming that 6.8 gets a stop run and we push below it, the next target we're looking at is around 6.5 to 6.6 thousand levels. And that is exactly why I'm not going to risk longing at 6.8 thousand. This is heavy support, so I do think we'll get a bounce, but I'm not going to take that risk. I'm just going to look for short opportunities. If we do happen to go down to 6.5 thousand, well then our targets on the retracement become a lot lower, which is unfortunate because I like to short from as high up as I can. But again, we have to take everything into consideration. So if we do dip below 6.8 thousand and we head to that 6.5 to 6.6 thousand level, our next short targets now become 6.9 thousand, right around 7,000, and above that 7.2 thousand, which will be this resistance here. Those will be my short targets where I'll start opening shorts if we drop down to the 6.5 to 6.6 thousand level. So to recap, my plan now is I'm not too concerned with the longs. Yeah, we could bounce here. We could get a nice scalp opportunity, but I'm not going to bother with it. I'm going to play the trend, which means I'm going to look for shorts. And where those shorts will be depends on where this bounce ends, or depends on where this drop ends. And if we do bounce from here, again, my targets for shorts are 7.2 to 7.4 thousand. If we dip even lower to the 6.5K level, my targets for shorts will be 6.9 to 7,000. Up to 7.2 thousand. I'll start scaling in shorts at those levels. I'll keep a few additional ones above just in case we do spike higher, but the bulk of my shorts will be concentrated around the 23% to 30% retracement levels. So that about covers it for this video, guys. I've talked about this structure here, why I believe that after we lost 7,000, there's no hope left for bulls in the short term, and why I'm now focused on shorting the market rather than longing. I'm officially back to being fully bear bias. I had a short-term bullish bias up here. I did expect us to travel a little bit more to the upside here once we got past 7.5 thousand, but that idea quickly stopped once we lost. Once we got invalidated here at 7.5. So back to fully bearish bias here, expecting lower lows to come in the very near future and looking to short that market. You guys know my targets. You guys know my reasoning, aside from Elliott Wave as well as the macro perspective. If you guys have any questions on anything that I just talked about, feel free to reach out to me on Twitter. Feel free to join my Discord where I talk about this stuff in a lot more detail. And yeah, thank you guys for watching. If you enjoyed, please like and subscribe. Thanks.